morning, everybody. My name is Chuck Chokel, and I'm here on behalf of Truth in Accounting to review the financial report put out by the Treasury of the United States of America. This report comes out every year, and congratulations to the Treasury Department for this year getting it out in January, well before the President's address to Congress. I want to tell you that this report covers through fiscal year end September 30th, 2024. The report is 245 pages, and the purpose of this YouTube video is to highlight what I think are the 8 most important pages and the most important numbers on these pages, so you don't have to try to read 245 pages. I think this is a very important report that receives very little attention in the media. What you will often hear about is the budget deficit each year of the United States, but there are many other fiscal issues that are contained in this report that I want to highlight for you. So I start on this first slide. You see the URL, how you can go to the original document. And you'll see I'm not making up these numbers. These are put out by the Treasury of the United States. All I do is highlight key pages and key numbers. So that's the URL if you want to go to it yourself. And this is the 5th year I'm doing the talk. I hope to continue to do this each year. And I hope you learn something new from it. So we'll turn the page and get started. So this is actually, this chart 1 appears both on page 3 and page 17 of the Treasury's report. And as labeled, it represents the United States budget deficit and net operating costs for each of the last 5 years. So what is the difference between the budget deficit and net operating costs? Well, the budget deficit is done on an accounting basis, cash only. That is cash received and payments made by the government. Whereas the net operating cost in these reports is done on an accrual basis. And that means revenues earned, but not necessarily collected, and costs incurred, but not necessarily paid. So you can look at the 2 different sets of numbers. In the red, you have the budget deficit, and the United States budget deficit for 2024 was 1.832 trillion. And that was up 138 billion over the prior year. Not a good result, but not as bad as we had during the COVID years of 2020 and 2021. But looking at the net operating costs of the US government, it was worse. We had a $2.425 trillion shortfall. And this is when you include things that haven't yet been paid, like government pension costs or VA benefits. So if you look at this chart, I think the net operating cost is far more credible and important and real to the United States taxpayer. But it's the budget deficit number that always gets the attention. Over the last 5 years, the net operating cost has been a negative $16.949 trillion, an average of $3.4 trillion per year for the last 5 years. That in itself is terrible. So we'll go to the next page. And this is page 14 of the Treasury's report, and I think it's a pretty good summary page. In the red boxes near the top, you can see the net operating cost deficit of 2.425 trillion and the budget deficit, 1.832 trillion, as mentioned previously on the last slide. But this gives a lot more detail. For example, on about the 5th line down, you can see the total taxes collected were 4.978 trillion, which is up 11.5%. So the government's collecting lots of taxes, but unfortunately spending more than that level of increase. So the next box includes assets and liabilities. And this is a very unusual summary. The assets, the United States has 5.662 trillion of assets, but I don't believe this number because it doesn't include many of the US government's assets, such as the millions of acres that the United States owns. Those aren't carried as an asset at all. The liabilities, total liabilities are 45.5 trillion. And this is made up principally of the federal debt and interest of 28.338 trillion. That's up 1.991 trillion from the prior year. We all know federal debt is going up. We all know interest payments on that debt is going up. And the next line, federal employee and VA benefits payable, that too is rising sharply, up 686 billion in a year to a total of 15.0 trillion. So the country's total liabilities are 45.5 trillion, and our net position, when you net the assets, is 39.883 trillion. So we'll round that to 40 trillion and keep that $40 trillion net position in mind as we go further into this talk. What's very peculiar is that you don't see any of the social programs, Medicare, Medicaid, Social Security, in these total liability numbers. Well, why is that? That's one of our largest payout areas. How is it not included as a liability? And it is not included except for the current year based on the cash basis of accounting that the US government uses. They don't really consider Social Security payments and Medicare as a future obligation, since Congress and the president can change the payout at any time. So they don't carry it on the books as a liability. However, below in the final box, they do, because everybody wants to know what are the sustainability measures of the United States fiscal position. And it's not good. You can see the Social Security and Medicare delineated there, a shortfall of 25.4 trillion in Social Security, a shortfall in Medicare of 52.8 trillion. So the total in the red box at the bottom there is $78.3 trillion shortfall. But this is based on a 75-year look for these social programs. In other words, the look considers all the incoming payments and the outgoing payments for the next 75 years, but truncates those exchanges at the 75-year mark. And as you'll hear in the rest of this talk, I think the shortfall is much worse. So if you take the $40 trillion net position and the 78.3 trillion shortfall in the social programs, you total $118 trillion shortfall for the US government's fiscal position. Now let's go to the next slide to see more detail on this 78.3 trillion of the social programs. And again, we're just looking at the social programs over the next 75 years. And there's two groups here identified. The first is called the closed group, and the second is called the open group. The closed group is defined by all those people who are 15 years and older in the United States collecting Social Security, or to collect in the future, those paying in as well. Whereas the open group are those under 15 years old and those yet to be born, anticipated to be born over the next 75 years. So you can see at the the highest red block there of $105.8 trillion shortfall in our social programs at the end of fiscal year 2024. 5 years ago, at the end of 2019, this was only 80 trillion. So we've gotten 25 trillion worse over the last 5 years, about 5 trillion per year, additional costs in our social programs. This is netted by 27.5 trillion in the 2024 year to get the 78.3 trillion we saw on the previous slide. Well, what is this net 27.5? How is this so profitable for the government? Well, it's based on the government anticipating collecting Social Security from those under 15 and those yet to be born over the next 75 years, paying out whatever benefits are due over the next 75 years, but then stopping all future payments and receipts. Well, if you take the young group and you collect all the premiums in, but you don't have the payouts when they get old, of course it's going to be very profitable. But it's an unrealistic view driven just because of the 75-year look being truncated. So we'll go to the next page. And you can see a different time horizon. This is page 184 in the Treasury's report, and I think it's the most important page in the report. It is the cost, the present value of the social programs, not over the next 75 years, but through an infinite horizon. So all the people anticipating to be born, what if the programs were unchanged, what it would cost our government. And at the bottom line there, you can see OASDI, that's Social Security, that's old age, survivor, and disability insurance, costing 65.6 trillion for the US government. Medicare Part B, that's hospital and doctors, 96.8 trillion. Part D is the prescription drugs, costing 20.4 trillion. And then HI, that's hospital insurance, and the government anticipates that to be profitable by $15.1 trillion. Now, why is it so profitable? Because this chart includes state transfer revenues. In other words, what are the states paying in for the hospital insurance? And for a taxpayer who's paying both federal and state taxes, you're paying out through your state taxes to make these payments. So it's not really a net positive. The federal government may get money from the states, but the citizen is paying out one way or the other on the hospital insurance as well. So the total of all these shortfalls over the infinite horizon is $167.7 trillion. That's enormous. And this is what I consider the most important number in this whole report. And again, it appears first on page 184 of the report. Now remember, this is just the social programs. And we saw earlier that $40 trillion shortfall in pension costs, federal debt, VA benefits, and future interest payments on our debt. So you have to at least add in the $40 trillion shortfall on those other things to the 167.7 trillion. And suddenly you see the United States is short over $207 trillion in its future obligations. So if you go to the next page, this is one that won't appear in the Treasury's report. All I did is take that 167.7 trillion for 2024 and mapped it going back 15 years. Back in 2011, the same number was 51.2 trillion. So in 15 years, our net obligations just on the social programs of Social Security, Medicare, and Medicaid are up over $115 trillion. The good news is that this 167.7 trillion is actually down 7.6 trillion from the prior year. And this is related to various assumptions about payouts and age demographics in the United States that I'll talk about in a little while. So it's good that we've hit our peak and starting to come down. It's terrible, absolutely terrible, that it's gone up over 115 trillion over the last 15 years. At least the government through the Treasury report acknowledges year after year after year that the country is on an unsustainable fiscal path. We've been on that unsustainable fiscal path for many years now. So go to the next chart. This is page 24 of the Treasury's report. And this is the liabilities by type for the last 5 years. Now remember, the social programs aren't seen as liabilities except for those in the current year. And these are principally federal debt and interest payments and federal employee and VA benefit payable. And you can see over the last 5 years, they've each gone up steadily. The federal debt and interest payable, now 28.338 trillion. The federal employee costs and VA benefits payable, over 15 trillion. And if you total up all these numbers, the 2024 number is 45.5 trillion, up 2.6 trillion from the prior year. So we go to the next page. What does the government spend all this money on? Now, I know this is a very difficult chart to read, and I'm going to blow it up so you can see it better on the next page. But I wanted to include this because this is 41 different categories, most of which are departments within the United States government. But I'm really going to focus just on the top 5 since they make up 80% of the costs of the federal government. So we'll go to the next page to get a blow up of the top 5. And there you can see the high cost of the Department of Health and Human Services at 1.738 trillion, Social Security, the current year 2024 cost of 1.530 trillion, the Department of Defense at 1.232 trillion, the interest on our debt, 909 billion, and the Department of VA Veteran Affairs, 472 billion. Now, the Department of Health and Human Services change year over year was only 1%, not too alarming, not too surprising. The Social Security Administration costs rose 7%, almost double the rate of inflation. The Department of Defense costs went up 23%. The interest on our Treasury securities went up 34% in a year. And the Department of VA Affairs went down 68%. So what the heck happened that we got almost a $1 trillion savings in the Department of VA year over year? Well, I can't explain all the difference, but I can explain at least 433 billion of the change. What happened was in 2022, Congress passed and the president signed the PACT Act, P-A-C-T Act. That stands for Promise to Address Comprehensive Toxics Act. And basically, this extended qualifications and disabilities for militaries, veterans exposed to toxics in various wars, including the Vietnam War, the Gulf War, all the wars in post 9/11 in Afghanistan, Iraq, and those people exposed to Agent Orange and burn pits and various other toxic exposures. So the law passed in 2022. The Treasury in 2023 for its financial report assumed that these increased coverage was going to cost $460 billion additional. Well, then they had a year of experience. How many people applied? How many people qualified? What were the payments? And they've revised all the estimates of this program down $433 billion in 2024. So in 2023, revised the estimate up $460 billion, and then the next year revised it back down $433 billion. That goes a long way to explaining the decrease in estimated cost, but not the full explanation. Now I'll go to the next page and just wanted to highlight a little, this is page 102 from the report on our borrowing, the federal debt and interest payments. Basically, there are three kinds of federal debt, major. There's many different kinds, but the three major ones are Treasury bills, those notes that are under 1 year in maturity, Treasury notes, those that are bonds 2 to 10 years in maturity, and Treasury bonds, which are those over 10 years maturity. And you can see in 2024 that most of the federal debt was in 2 to 10 year Treasury notes, 14.338 trillion. And you can see the average interest rate on this debt was 2.7% per year. Well, that was up from the prior year of 2.1%. Now, 2.7 versus 2.1 doesn't sound like a big change, only 0.6, but that's a 29% increase in the interest rate for the largest subsegment of our debt. Now, in Treasury bills, you can see the interest rate went down from 5.4 to 5.2%. And for Treasury bonds, it went up from 3.1 to 3.2. I've said this before in prior years, and I'll say it again. I think the Treasury and the United States government would be very wise to issue longer bonds at today's, what I view as relatively lower interest rates, because I think in the future, and I'll explain why, there's going to be a lot of inflation. And I think interest rates in the future are going to go way up. So this is the summary of total Treasury securities, net held by the public, 28.184 trillion. That's as of September 30th, 2024. As of today, it's over 30 trillion. You probably read headlines about US debt passing 30 trillion. We go to the final page. This is page 145 of the Treasury's fiscal report. And I enjoy this because this one lays out the detailed assumptions of a lot of different categories. So this is one to really pay attention to when you want to know what's going on. I could talk about a lot of numbers on this page, but I'll really focus on two big areas. The first being immigration, the second being inflation, since those were the two biggest political issues of the last year's election. So if you look at 2024, the third row down, net annual immigration. So in 2024, the Department of Treasury is telling us we had 1.8 million immigrants come into the United States. Now, this category includes both legal and illegal immigrants. Well, I think we actually had far more, because I don't think the count of illegal immigrants is very accurate, and I don't actually know what specifically is included for illegal immigration in 2024. I can tell you, if you Google how many legal immigrants are allowed into the United States. It says 2.6 million. So I don't know Google's source, and I can't reconcile it with the Treasury's report, but I think we get a lot more immigration than the 1.8 million in 2024. But even so, you can see the Treasury is anticipating that drops substantially as we move into the future. The columns that you see, 2030, 2040, 50, are the average estimate per year over the decade of 2030, 2040, 2050, et cetera. So immigration, as our country grows, is expected to fall to only 1.2 million immigrants per year. That's a surprisingly low number relative to our recent history. A lot of interesting things on average age. I won't go into all the detail, but you can see males now are assumed to live to 76.4 years, females to 81.3. And over the next 75 years, males are going to live on average 7 years more and females 6 years more. So we all know that our country is aging and people are expected to live longer each successive decade. Now go to inflation. Down below in economic assumptions, look at CPI, Consumer Price Index, of 2.8% in 2024. This is down from 4%, 4.0 in the prior year, and is expected to fall further, 2.4 over the next 7 decades. So this doesn't really forecast recessions or spurts in growth or printing of money. I think that's going to be the real driver of inflation in the future. What is good about 2024 is that the country had real wage growth. Wages increased an average of 3.8% per year, which was greater than the inflation index of 2.8. So we had real wage growth 1.0, the difference between those two. And real wage growth is expected to grow and then shrink back down and be positive throughout the next 70 years. If you skip to the bottom, these are the assumptions underlying the social programs, and there have been some big changes here. For example, the per beneficiary cost under Medicare Part B last year was 7.8% for 2023, and it fell to 3.7% in 2024, but is assumed to go back up to an average of 6% per year for all of the 2030s and then drop to 5.1 for all of the 2040s. But that's a lot of future inflation in healthcare costs. Similarly, we saw a big jump in 2024 in drug costs, up 9.3%. Again, expected to fall substantially over the next 70 years. Make one last comment about average annual interest rates. You can see there where it says average annual interest rate 4.6% for 2024. This is about normal. It's forecasted to go down and then come back up, down in the 2030s and then back up for the 60 years following. So 4.7% is kind of the expected long-term average interest rate we will pay, says the Treasury. So that's it for the 8 most important pages of this Treasury report and many of the most important numbers. I'm pleased that the Treasury puts out this report. I encourage you to read it. It's my dream that this be taught in high schools and colleges and that students learn this. In fact, I wish all citizens of the United States would watch this YouTube video and learn a little more about the financial condition of the United States. It's in bad shape. we have far, far more future liabilities than we have anticipated payments or tax revenues. I won't take questions because I always get asked the same thing. If we're in such financial fiscal trouble with over $207 trillion of future obligations unfunded, how the heck are we going to pay for this? And my personal assumption is that everyone will be paid every dollar owed, and the United States will print money and print money and print money to pay out Social Security and Medicare. The current president is trying to change our fiscal position substantially through tariffs. Maybe that'll work, maybe it won't, but it's clear we do need to cut government costs because it's gone up so far. And I applaud the efforts to cut costs. I think the fiscal hole our country is in is so large that even finding $2 trillion of savings, while enormous, would not solve the entire problem for the United States. So thank you for taking your time to watch this talk, and I hope you found it useful and interesting.